So I just got off the phone with a high-level advanced planning estate attorney. And in our conversation, we talked about everything, all different types of trusts, advanced estate planning, advanced tax planning, different tax strategies, even international cash flows. These are the exact types of strategies that high net worth and ultra net worth families use to preserve their capital through generations. We're talking generational wealth strategy. And here's what hit me. Many people think they lack access to these strategies, but the real problem is people lack the education and financial literacy to even get themselves to the starting line. Just as an example, this attorney, who makes great money by the way, has low-cost entry points for everyday people. And we both run into the same exact problem. Too many people want and ask for advanced strategies that are not relevant or valuable to them, at least not yet. For example, they want trust before they have assets truly worth protecting through a trust. They want tax strategies before they hit an income level where the tax strategies actually make sense for them. In essence, they want to run before they even walk and even crawl. And that's because, yes, of course, this advanced stuff is super glamorous. We read about it in the news and we get enticed by what other wealthy people are doing, which isn't necessarily a bad thing at all because success does leave clues. However, what the news and the tabloids don't tell you about these advanced strategies when they talk about the very rich and famous are the initial strategies that got them there in the first place. The initial strategies that most people think of are boring or standard advice. They're actually there for a reason, a very important reason, because they are the foundation and the first stepping stone to getting to where you ultimately want to go. But if you don't start there, the chances of you making it to an advanced state are slim to none. Look, covering your bases, the basics are not basic just because they're simple or boring. They're basic because they are foundational. Cash flow discipline, protection, entity structure, and consistent investing and accumulation of assets. I promise you, every high net worth family started with those basics. This attorney confirmed what I always knew. He works with these ultra high net worth families, and he even said they started with the basics. Today, they might be using very complex entity formations combined with multiple trusts, multiple businesses, maybe even doing international business. But somewhere along the way, even if it was a prior generation or two prior generations back or more, it started with the basic. They built assets first. They protected those assets. And then they scaled and optimized. And that sequence does matter. And here's the real danger. Too many people I meet choose to skip the boring foundational aspects of planning, and they try to skip this level, and then they never end up where they wanted to go. And because they skip that step, they never build something worth optimizing and scaling. And even sometimes they try to optimize and scale something before it's ready, and they end up in a worse place than where they started. And so I just want to take a few minutes and dispel some common myths and common errors that I see in terms of how people view their finances and their plan. And also, I think the root problem of this is just education and financial literacy. So I'm going to give the basics behind why the standard foundational advice is what it is today. Because when you zoom out and look at the basics as a whole, it all makes logical sense. And by the way, in case you're new to the channel, I'm Sean Shakarami. I'm a CPA and I work for one of the leading financial advisory firms here in Naples, Florida. I help families, business owners, and the self-employed protect what matters most. And as an important reminder, this is just for educational purposes, and none of this should be taken as advice. You should always seek the help and expertise of a professional before making any important decisions. So number one, I'm sure you've heard it said that you need a 3 to 6 month emergency fund. Yes, I think that is common sense, hopefully, but there is an actual reason why people say 3 to 6 months of an emergency fund. First, what does 3 to 6 months mean? It means 3 to 6 months of expenses. If something were to happen, hurt, injured, sick, can't work, we all have fixed expenses. That would be things like your rent or mortgage, car payments, groceries, medical bills, the essentials that you just need to survive. The reason that you need 3 to 6 months of an emergency fund that covers your full monthly expenses is because most disability insurance policies start at either the 91st or the 181st day after a potential disability happens. So for example, you have 3 to 6 months of an emergency fund. Something happens to you, sick, hurt, injured, can't work, can't generate an income. You have to be able to make it at least 3 or 6 months before a disability insurance will start covering those expenses, which leads to the logical step number 2, disability insurance protection, or another word that I like to use for it, income protection. If something bad were to occur, which happens way more often than people think, statistically, 1 out of 4 men and 1 out of 3 women will experience at least one disability during their working career. And so should something bad happen where we can't generate an income, that's why we layer on the disability insurance. After your emergency fund is then depleted, your disability insurance kicks in to where your lifestyle doesn't change. And hopefully you have enough income protection to where you can rebuild that. Then number 3, life insurance. Interestingly enough, after speaking with the attorney, he also confirmed life insurance is far from boring. And depending on where you are at in your season of life and your stage of wealth, life insurance can become a very creative asset to help you. However, basic life insurance is hugely important. And here's why. For most everyday Americans, we are accumulating our wealth and our retirement through either our 401k employer-based program or through an IRA. And for those of us with families, especially families with children, the average American wouldn't yet have enough accumulated in their estate or in their retirement to fully cover the ongoing needs of your family. And that's not even getting into the term versus perm debate and how potentially whole life insurance protects your legacy and also protects your retirement nest. And so yes, those first 3 steps sound very simple, if not boring, the standard advice. But here's the thing. Without those protections in place, we all know life throws curveballs, and if we're not prepared, if we're not planning, then when one thing goes bad, it can easily become a financial catastrophe, and it can change your entire financial trajectory for the rest of your generation. And that has consequences and ripple effects into the next generation of your family as well. And so it's these protections and these basic first steps that, number 1, help you become financially disciplined. Getting good at finances is a lot like going to the gym. It's not a switch that you just flip on and off. It grows your awareness of how your finances are tied to your health and even your mental health well-being. And what I consistently find is as my clients practice these disciplined habits over 3, 6 months to a year, they start growing in their financial discipline and are able to save way more than they ever thought possible. And the people who struggle are those who overanalyze and get caught in the trap of inaction. It's one thing to make a mistake, make a bad decision, but at least you took action. By taking action, because it's by taking action that we can also fix and resolve those mistakes as well. Too often it's the people who wait, then something bad happens, and then when they want the protections, when they want to become more financially disciplined, it's much harder than it should have been, and sometimes those options are no longer even on the table for them. And so here's my biggest takeaway. Defense still wins championships. Look at the last Super Bowl with the Seattle Seahawks as a great example. And wealth is not built on glitz or glamour. It's built on consistency, small steps that compound over time, all the boring stuff. And so if you're early or ready to start this journey, your job is not to master any advanced strategies. Your job is just to start. There's a famous proverb that said the best time to plant a tree was 10 years ago, but the second best time is today. Because once you decide to take that first step in the right order, the sky really is the limit. Let me know your thoughts. Comment down below where you stand and if you've ever gotten distracted by the more glamorous advanced strategies before you're ready for them.